Support and resistance levels are used by traders to identify entry and exit prices, as well as stop loss and take profit levels. While there are many trading strategies and technical indicators for traders to use, support and resistance is amongst the most popular when carrying out technical analysis. Traditionally, we calculate 3 major support levels and 3 major resistance levels. These are formulated with the use of highs and lows of a time period and a closing price. In calculating support and resistance levels, we first calculate pivot levels. Movement through pivot levels brings support and resistance levels into play depending on whether it's a bull or bear market. So the theory, support levels refer to price levels below which an asset does not drop for an extended period of time. At support levels, buyers enter into long positions. It is important to note, however, that there are multiple support levels. Traders may wait for confirmation before entering into a position at a support level. If there is no confirmation at a first major support level, then the second major support level comes into play. It is also important to note that once a support level is breached, it becomes a resistance level. Conversely, resistance levels are where traders exit a position or enter into a short position. Resistance levels are price levels above which an asset does not move above for an extended period of time. Again, traders tend to wait for confirmation before entering into a trade. If the price moves above a resistance level, the next resistance level comes into play. The breach level will then become a support level. When considering support and resistance levels, traders may also use pivot levels as a guide to when support or resistance levels are likely to come into play. At a time when an asset price is above the pivot level, the asset price would need to hold above the pivot to support a run at the major resistance levels. A fall through a pivot level would bring support levels into play. Conversely, if an asset price sits below a pivot level, a move through the pivot would be needed to bring resistance levels into play. Failure to move through a pivot level would leave support levels in play. Looking at the euro versus the US dollar and the hourly candlesticks on the 3rd of December, relatively choppy start to the day, we then saw the euro move through the pivot level through the late morning and then test the first major resistance level at 1.1339 in the early afternoon. For traders looking for confirmation, the first major resistance level held, with the next hourly candlesticks seeing the euro pull back. The euro then fell back through the pivot at 1.1302 and then tested the first major support level at 1.1271. Again, traders would have been looking for confirmation, and the next hourly candlesticks delivered confirmation that the first major support level held. The euro then moved back through the pivot to wrap up the day in positive territory. In a more volatile market, we could see an asset break through the day's 3 major resistance levels or fall through the day's major support levels. A market event leaves sellers or buyers on the sidelines, leading to the lack of resistance or support. If we consider market reaction to news of the Omicron COVID-19 strain, the Japanese yen drew plenty of buyers during the flight to safety. Price action on the day saw the US dollar slide through the day's major support levels, testing support at a psychological level at 113.0 against the Japanese yen. In such an environment, going long dollar yen would need to be based on longer time horizons and not based on the support and resistance levels for that given day. Also, in response to the news of the Omicron strain, we saw carry trade reversals, driving the euro northwards against the US dollar. Here the euro broke through the day's major resistance levels. Traders holding on to long positions would continue to hold, while short position sellers would have exited at some point between the pivot and the first major resistance level. For the euro on this given day, resistance at 1.1325 proved to be the key, preventing a run at 1.135 levels on the day. In the world of trading, while major support and resistance levels are key, there are others that traders need to be mindful of. These would include current day highs and lows, as well as weekly, monthly, and all-time highs and lows. Sticking to a trading strategy can prove challenging in volatile market conditions. In the long run, however, once you've found a strategy that works, stick to it. Traders can't expect to make ground on each individual trade. It is the majority of trades that count.